Hello and good evening, everybody. Good evening, Geoff.
Hey Benny, good to see you. Can you hear me
Good to see
okay?
you too.
Yeah,
Sorry?
you can hear me okay?
Yep, loud and clear.
Awesome.
Okay, guys, if you can hear us, before we start, can you just say yes on the comment section so that we can begin? Right, so tonight we have Geoff Howie with us, who is the market strategist from the Singapore Stock Exchange, or SGX, who's going to give us an update on the banking sector and what's hot in Singapore. Right, so please say hi to Geoff, who's our guest tonight. Thank you, Brian. Okay, it looks like we are set to go. Philip, thank you. All right, thank you, everyone. So yes, and it's our pleasure to have once again Geoff Howie on our live stream tonight, and he's going to share what's hot in Singapore. He's the man who knows what's happening in Singapore, especially when it comes to the stock market and the financial markets. So before we start, just have to announce a disclaimer first. Whatever that's being shared here today is for educational purposes only. It's not intended as any investment advice. And if you want to look for investment advice, please do look for a licensed investment advisor. All right. And okay, if you guys are ready, then we are set to go. So Geoff, since we are talking about the Singapore banking stocks, right? How have the Singapore banks performed this year?
Yeah, the trio of so we got the three banks here: DBS, OCBC, and UOB, and the trio, they make up 20% of the total market cap of all our stocks listed on Singapore Exchange. So at the moment, the total market cap's something like very close to 900 billion Singapore dollars, and those three banks make up 20% of it. They also make up 20% of our day-to-day turnover, which currently is around $1.2 billion a day. But more importantly, I guess, they do make up 40% of the STI. So they have a very big impact on what the STI does on a day-to-day basis. And so far this year, the three banks, they've averaged 21% total returns. And that's marginally less than global banks. They are up around 24% in the year to date. So DBS has generated a 24% return, total return, in line with the global benchmarks for banks. UOB's gained 20% and OCBC's gained 19%. Both DBS and UOB have also kept in line with the 3% gain of the global banks since the end of June, while OCBC has actually generated a decline in total return of about 1%. So the trio, if you look over the last 20 years or so, they have generated very, very similar total returns. It's uncanny. It's 20 years up till today, the average annualized total return of DBS was 9.8%. For OCBC, it was 9.5%. And for UOB, it was 9.3%. So they've been very, there's a long-term resilient there, but nonetheless, we've had a little bit of short-term volatility, which I guess we can talk about,
Yeah, so it's basically like if you want to follow the STI index, you can just take a look at invest in these three stocks, right? Because they are quite heavy on the index.
Yeah, very much so. In fact, there's basket traders that exist that instead of trading the STI through an ETF, they prefer to trade just the few of the stocks that are basically the heavyweights, and that will always include the three banks. Sometimes it includes the likes of Singtel. It could include CapitaLand, Wilmar, or SGX as well. But generally, for those basket traders, they will pick about 5 stocks, and you're going to have the three banks in there. We were there's a story that MoneyMind, Channel News Asia, are going to run on Saturday night, and they're looking at a lot of the family-linked businesses, family-linked empires that are part of the Singapore market, and it's the Wee family who have UOB as well as UOL Group in the STI, and they actually have a higher weight in the STI than the four Keswick family Hong Kong Jardine group of companies that are in the STI. So the banks, yeah, very, very important.
Right. It definitely has performed better than the Malaysian banks, because I think year to date the Malaysian banks have not gone anywhere. I think some are positive and some is still in the red. So definitely Singapore, I think, have this international exposure, will probably have more benefit than the Malaysian banks right now.
Yeah, I mean that can be a pro and a con. We don't have that we are more correlated with the big international banks across the world than we are the developing banks across Asia, which is interesting.
Yeah. Okay, let's talk about Evergrande or Evergrande. I don't know how we pronounce it in English. It's supposed to be Evergrande.
Gee, much better than my Malaysian, my friend. The best I can say is every Friday, Selamat Tengah Hari Jumaat. That's about the best of my Malaysian.
Yeah, because it's actually translated from Chinese, so I don't want to even attempt to say it in Chinese.
Yeah.
But so yeah, everybody's been talking about Evergrande and and its effects on banks internationally. So I was wondering whether Singapore banks actually have any exposure to the Evergrande debt crisis right now.
Look, there's been so much regional focus on the future of China Evergrande, and that's everyone's interested in it because you've got the social toll of the real estate defaults. You've got the clear mandate from the policymakers to really rein in and ring fence the debt of the China developers, which is why it has so much focus now, because they have been making steps, policymakers have been putting in some pretty stringent steps over the last year or so, and now it's crunch time. And I guess the potential systemic impacts to the counterparties and the industries, the adjacent industries, the market is still also really still assessing the implications as well of a structural decline in real estate activity in China. And that China, the real estate sector, it accounts for somewhere in the vicinity of around 10% of China's GDP. There's estimates at 7% to up to 15%. It varies obviously on a year-to-year basis, but it's in the vicinity of 10%. And the trio of our banks, DBS, OCBC, and UOB, they have maintained that they do not maintain direct exposure to China Evergrande Group. And China Evergrande Group is a listed company in Hong Kong Exchange. So they also publish annual reports, and none of the Singapore banks come up as principal banks in that annual report either. So we kind of knew that before they reaffirmed it last week. I guess for China, though, and what's happening in China, DBS and OCBC, they have or they report more net revenue to Greater China, and they also have more loan exposure to mainland China than UOB. In the first half of this year, I think almost 10% of UOB's net revenues were reported to Greater China. OCBC reported 14% of its revenue to Greater China, and DBS reported 25% of its net revenue to Greater China, but approximately 2/3 of that 25% was because of its Hong Kong operations. So I guess you could look at it quantitatively as well. DBS and OCBC, they maintain an insignificant but it's positive, simple correlation to the performance of the FTSE China A50 index. So the FTSE China A50 index, it's about 40% weighted to financial services, and DBS and OCBC, they don't have a significant correlation to it. In fact, DBS is a bit more significant, is around 40%, and OCBC might be 10%. But what's interesting is that UOB has a negative correlation to the FTSE China A50 index. So quantitatively, there hasn't been much significant correlation with the performance of the online indices. I think it's more the impact is, as it is through most sectors and industries here, it's through trade and finance channels. For our banks, though, look, the key growth drivers of the bank, China is obviously a part of that. The trio, where they have, I guess, commonality in their growth drivers, it's digitalization, it's the broadening of wealth management services, and a continued focus on supply chains and these growth markets, which of course can include the supply chains of growth markets. Hence, China is very important. I think there's a slide of you've got a couple of slides of mine. If you want to just flash up the first one, I can show you how show you some of the growth in the wealth management business. Yeah, in the lower left chart, there's a chart that's showing how combined DBS, OCBC, and OCBC have combined wealth management net fee and commission income has almost tripled from around 700 million in the first half of FY14, which is the first 6 months of 2014, to very close to $2 billion for the first half of this year. The growth markets, China, as I said, is a big part of that as well. And the combined annual income that is segmented to Greater China, that's also grown from something like 2 billion Singapore dollars in 2010 to more than $5 billion last year. So there's a lot of, I guess, as I said, that there's the drivers like digitalization, wealth management, but also the growth markets, of which China is a key one. UOB's, I should also mention, rest of Southeast Asia franchise has also been growing quite a bit too. It grew 7%, I think, in the first half of this year versus the first half of last year, with strong growth in both Indonesia and Malaysia. And DBS also highlighted this year, I think it was the amalgamation of the LVB business in India and their securities joint venture in China is working to enhance their presence in key markets. So I guess they don't have, as I said, the trio do not have direct exposure to China Evergrande Group, but the impact that real estate has on China growth and the slowdown in China growth that we're seeing does have an impact on the overall market here. And financial services is crucial to China growth as well.
Yeah. So in your opinion, Geoff, this Evergrande, of course, is the largest property development company in China. Do you think that this is just that Evergrande is the only property company or property development company that's facing problems, or do you foresee other developers in China is going to face the same problem?
Well, others have. I think there's a company called Fantasia, which is in the focus now too. The key thing is it's massive. I think it was it ranked 122 in the Fortune 500 this year. So the aspect of it is it's when companies are really big. That's when the systemic issues start to come in focus. But it really depends on each stock, each of those companies, and you have to take each of those companies, the financials of each of their companies into account when you make those decisions. For instance, we've got developers in China, a prominent one that's in China, Yanlord Land Group, and that's reported, for its first 6 months of this year, it actually increased. You could see it increased its deliverables, its delivered units. Where when you look at what China Evergrande did over those 6 months, it didn't, and that's on the back of the rising costs, of course, and the falling market. So each stock, I guess, it's a signal that there have been stresses, and there have been stresses in this market for some time, and excessive debt, and this is the issue. Evergrande might not be the only one. There could be more, and that's why we don't know yet. Market is still trying to work it out and see what happens and how China deal with it. But obviously, that there is concern because the PBOC has been pumping liquidity in through its repos. So, it remains to be seen, Benny.
Yeah, right. So do you think that investors, if they are investing in the banks in Singapore, they should really look at or at least follow the developments or economic developments in China?
Yeah, look, I mean, we've got different stocks that they really have to focus on. For instance, we've got the FTSE ST China Index, right, which is very, very much a 20 stock or so index that's very focused on China, because to be a part of that index, you have to have 50% of your assets based in China, or you have to generate 50% of your revenue in China. And those companies, they include quite a few real estate names. They include industrials, some technology companies, and some consumer staple companies. Now, they are very, very important. The China economy and the slowing down, the deceleration of growth we're seeing broadly when you look at retail sales and industrial production, they are being weighed. I mean, it's the China economy had a great start to 2021, as did many Chinese indices, as did our China indices, our FTSE ST China Index, and Yangzijiang Shipbuilding Holdings, which is a container ship builder, and it builds other ships too, but its orders for container ships have gone through the roof with the crunch in global trade. And that stock had a very, very strong start to the year, but ever since the slowdown, since the end of the first half through the third quarter, we've seen a lot of those stocks pare those gains that they made. So that's on the back of economic weakness. So yeah, it's having a big effect. Banks have been, as I say, a little bit more resilient. And we can go into some of the numbers and so forth as to why, I guess, if you like.
Right. Guys, if you have any questions for Geoff, you can type in those questions, and then I'll bring those questions up for Geoff to answer if it's related to what he's speaking about. All right. We do have a question here, Geoff. Sijia. Now we are moving a little bit from the Evergrande crisis right now, and moving back to the Singapore COVID cases, because we do see a jump in the number of cases in Singapore. So Sijia is asking, will the increasing number of COVID cases in Singapore impact those banks in the next 2 quarters?
Yeah, the increasing in COVID cases is expected, okay, and that's been expected for the last few weeks, because we've gone past our 80% vaccination rate, and like many countries in the world, you have to kind of make sure just kind of start moving on with your economic progression and let the variants and so forth run through the system. The number in cases isn't so much the concern. The concern is if the strain it puts on the hospitality system, on the hospital system. So as long as we've got enough oxygen cylinders, we've got enough beds in ICU, we've got enough hospitals, we can still get on with the job and don't have to look at any further constraints and restrictions on social movements. So the increasing in COVID cases, in this 2 quarter, obviously if we didn't have the COVID cases, it would be better. Obviously, I think one of the key things Singapore really need is to get our borders opened as well, and to basically have some more resumption to normality, because many of the customers of the banks obviously are involved in the F&B businesses, the retail businesses, the hospitality businesses, and so forth. So I wouldn't say it's there are a lot of international factors that come into the banks as well. I don't want to kind of say, well, no, not at all, but will it affect it? But during the crunch time in COVID-19, we've all remained resilient investors. The world still needs to invest. If we can't be investing and thriving in the consumer-related activity, the consumer-related industries that have been struggling because of the COVID-19 constraints, then we find another way, and it might be a more industrial manufacturing type of businesses that are more conducive to operating without less impairments during the COVID-19 constraints.
Right. Yeah, I guess Malaysia is opening up its borders quite soon. The government says that once we reach 90% of adults getting vaccinated, the first border I think they want to open is actually Singapore.
Oh, that's love to hear that. I mean, we had 90 flights a day, but
Yeah.
a couple of years ago, 90 flights a day between KL and Singapore, and my favourite getaway is Batu Batu off the Mersing Islands as well. I mean, I know it shouldn't be. It's not all about me, but I just can't wait to go there again. I really miss it. Lovely,
Yeah.
lovely place.
All right. Now, since we're in the third quarter right now, Geoff, when are the banks are expected to report next, and what were their numbers like in the first half of the year?
So for the latest stats on banking operations in the second quarter of this year, which ended in June, DBS, OCBC, and UOB, as you can see in that bottom, that lower right chart. Actually, it's not that clear, but you can get the gist of it. That the blue line, the orange line, the histogram of the blue, the orange, and the grey are generally getting higher and higher and higher. That's the net interest income. So the combined net interest income of the three banks was 5.13 billion in the second quarter of this year, and that was up 1% from the first quarter. For the trio, it was the highest quarter-on-quarter increase since the third quarter of 2019. And that second quarter, it's interesting because we can talk a little bit about the difference in the bank financials. The second quarter net interest income growth was led by UOB. When you look at it from a year-on-year perspective, year-on-year, its net interest income was up 8% from the second quarter of FY20. The net interest income, though, for DBS and UOB was actually down year-on-year. So that net interest income year-on-year growth for UOB also saw UOB post a year-on-year increase in its revenue of about 7% year-on-year for the second quarter. DBS revenue year-on-year for the second quarter actually declined 4%, and OCBC's revenue year-on-year actually declined 2% as well. So I guess all three banks, they reported a year-on-year increase in their loan books in the second quarter. And again, UOB led that with 6% increase in its loan growth. And bottom line, I guess all three banks, they did post year-on-year net profit in the second quarter of this year. So it was up 59% year-on-year for OCBC, up 43% for UOB, and it was up 37% for DBS. Now, the banks will report their third quarter numbers they should be complete by the first week of November. So we've still got another 4 weeks or so. But I might actually, if you can go to the next slide, Benny,
Sure.
we show some ratios too, comparative ratios, because it's interesting when you look at there are some little differences, if you will, in some of the performances and whatnot. For the ratios, I mean, this is for the first half of this year, OCBC maintained return on equity of 10.8%. Now that compared to 10.1% for UOB, but was pretty much higher for DBS at 14%. For the capital adequacy ratios, OCBC, its common equity tier 1 ratio was 16%. It was 14% for UOB and 14.5% for DBS. And the NPL, non-performing loan rate, was 1.5% for all three banks. I guess what's interesting too is DBS, OCBC, and UOB, with the DBS actually reduced its allowances quite a bit more than UOB and OCBC as well since the second quarter. So DBS has seen some marginal outperformance since the end of June in the share price as well, while OCBC, as we say, it's underperformed a little bit over the last few weeks. And MAS, it had a cap on the dividends that were to be paid. I think it was 60% of FY19 dividends could be paid in FY20, and it lifted that cap this year. Now, payout ratio is a bit different too. So according to the Bloomberg data, the dividend payout ratios, and remember that's the total amount of dividend paid proportionate to the net profit. So for the first half of this year, it was 52% for DBS, it was 50% for UOB, and 42% for OCBC. And the lower payout ratio for OCBC, it actually was discussed at the first half results briefing, and the CFO actually noted that the group had reverted to its 2019 interim distribution per share, which was 25 cents, and the payout ratio was more of a secondary consideration for them. But he maintained it does remain between 40% and 50%. As far as, I guess, the current valuations go, the average price to book ratio of the three banks is currently 1.15 times, or a 15% premium to the book value. And that's pretty much in line with what you see, as I said, global banks. Globally, your top quartile of global banks by market value are trading at an 18% premium to book value. So we're pretty much aligned with them. And like the top quartile of global banks, by market value, we've moved. These trio moved from an approximate 15% discount at the end of October last year to a more than 10% premium at the present. But I guess where it could go, and I think we might have touched on. No, I don't think we did touch on it in August. The average PB ratios for DBS, OCBC, and UOB, that they're still well at 1.15 times average. It's still well off the 40% or the 1.40 premiums observed back in April, May 2018. And that really followed a really super strong year for the Singapore stock market in 2017. And our economy as well was one of the strongest advanced economies in the world back in 2017. So there's some context for where we have been. But
Right.
like most economies, we still got a long ways to go. But these are some of the things that some of the retail investors here in Singapore have been looking at for the banks.
Right. Thanks, Geoff. We know that Singapore has been, got away from the lockdown way before Malaysia. I mean, Malaysia is just starting to open up the borders. But how's the retail flows to the banks been like this year?
Yeah, it's interesting actually from a tradability perspective. The banks have been highly tradable in terms of average daily trading ranges, the amplitude of the stocks difference between the high and the low, and the intraday volatility has suited the short-term traders that look for trading some of that seesaw or bouncing around market conditions that we've seen, led by things that are happening globally. From a tradability perspective, the big moves of 2020 and early 2021, they attracted a surge of retail investor flows into our market and into our banks. So we've noticed, I guess, since the end of 2019 that the net retail inflows, they tend to, the net retail flows tend to be inflows amid market weakness and outflows amid market gains, akin to value trading or buying in the lows and looking to selling as the market rises. And DBS is so close to 2 billion Singapore dollars in net retail inflows for the first 3 quarters of 2020. The volume weighted average price, the VWAP price of DBS over those 9 months was $21. Then DBS Group Holdings, it saw net retail outflows, net selling for the retail market of $1.9 billion in the subsequent 3 quarters of the 4th quarter of last year through to the end of the 2nd quarter this year. So of those 9 months, you had the volume weighted average price of DBS at $26.40. So the VWAP price amidst the 3 quarters of the significant amount or similar amount of net retail selling to the net retail buying was more than 25% higher than those 3 quarters of the significant net retail buying. So that was in that DBS. That's our biggest stock. So and it's a most traded stock as well. So you know, there's I guess one of the big trades we saw over an 18-month period. Very kind of measured moves, as I said. While DBS was trading at $21, there was net retail buying of $2 billion over 3 quarters, and then when DBS had a VWAP of $26.40 over the subsequent 3 quarters, you had net retail selling very close to $2 billion. So far this year, the retail have been net sellers of the banks. So retail flows, 1 billion of net retail outflows this year for DBS, and UOB 280 million, and very similar amount, 280 million of net retail outflows for OCBC. So they, as we say, they've been sellers. Net retail have been pretty much sellers this year. Basically, very different story to last year when they were big buyers of the banks. So there's, you know, that's what's been happening. But I think, as I say, it's a very it's an interesting market, our bank markets, because, as we say, it's, you know, that was a really good question before. You know, how focused are they on the local factors, particularly the COVID developments? A lot, you know, there's a lot of big factors that, you know, are there that you know, really drive their performances. And as I say, they have been moving. They're on the move, and when the markets are on the move, you know, and generating decent trading ranges, we tend to see more volume and more retail participation. Less retail participation, I guess, last quarter, because last quarter was a particularly quiet quarter for the global banks, as well as the STI. The STI had its most narrow trading range in 4 years, back in the last quarter. So it's been a little bit more muted lately, but nonetheless, when the markets are on the move, you tend to see quite a lot of participation.
Right. We are now in the last quarter, right, Geoff? And do banks cyclically or historically have had window dressings towards the end of the year? I know that the banks that you have mentioned have already gone up about 20% year to date, roughly about 20%. So do you think that there will be a window dressing for the banking sector as well?
Yeah, you know, interesting, because you look at the first 2 quarters, it was different. The first quarter, the banks were the strongest sector across the world in the first quarter of this year. And that meant the STI was, you know, all my reports were about, STI, best market in Asia, you know, strongest market in Asia, and so forth. Yeah. But what happened at the end of that is that it appeared that when it came to the window dressing day, institutions were trimming their weights, basically trimming their broader exposures. And then when it came to the next quarter, end of the quarter, we saw the opposite. We saw a lot of buying in the Singapore stocks. Basically, potentially institutions were broadening their exposure, or increasing their exposure, or increasing their weighting to Singapore. So I guess what it really depends on when it comes to the window dressing, particularly for the index stocks, Benny, is what the outlook is for the next quarter, and are funds or investors basically increasing their weighting to our countries, to the region, on the back of generally, you know, growth outlooks and so forth. So it does matter, you know, as I said, that question about COVID-19 cases, it does matter, because particularly on window dressing, when there are a lot of rebalancing that happens at the end of the quarter. But just because the market goes up very strongly doesn't necessarily mean they're buying more and more and more, or increasing their weighting. Sometimes you know, it can be the other way around. Right.
Okay, there is a question from Asija, but before I go to the question, because this is related to his question as well, how do you see the inflation rate in Singapore going?
Well, yeah, I guess it depends. I mean, it depends which part of the inflation rate you want to look at. Are you looking at the cost push or the demand pull? If you're looking at the cost push, then it really depends on commodity prices. Commodity prices have not gone through the roof per se, and that's, I don't know if I should be using that adage, but what I mean is that a lot of commodity prices, except for oil, have not gone through their early highs made earlier in the year. So that's given credence to the school of thought that inflation is transient per se. You know, it's been the structural adjustment, this structural change to the commodity prices on the back of the decline in the US dollar, and that's put all the the PPI prices up and not really flowed through. And then the demand pool, such as what we've seen in the US, is the whole reopening phase, the pent up demand driving up prices and so forth. I mean, it does make sense to have some inflation because we've got growth. We're forecast to have growth around 6% this year. It is obviously going to happen, but at the moment, it really also depends on what happens in the rest of the world. How well OPEC continue to manage the supply on the crude oil will obviously have a big impact on the supply side, but on the demand side as well, it remains to be seen. But at the moment, that it's at that 2% level, which is quite manageable, and it'll be interesting. We've got the semi-annual MAS monetary policy statement that will be released, should be released next week. That will be of great interest as well. See what they say.
Yeah, because I mean, if you look at the official numbers, they don't really go up. But when people read news, you see commodities prices, like you said, oil has been going up, and palm oil has gone up to historical highs.
Yeah.
And we have prices of metal, and because of the supply chain which is being affected, you see vehicle prices, and even all the other raw materials are going up.
Right? Housing prices.
Yeah.
That's the funny thing about inflation. They never take into it. CPI doesn't include housing prices. That's we use that separately. But nonetheless, some of that strong acceleration in housing prices that we saw at the late end of last year and the beginning of this year has had some of that pace has subsided somewhat, but it's still quite a resilient market. But then we have had cooling measures in place for a good 10 years as well here in Singapore. So that part of it is managed.
Right. So looking at the trends of interest rates, Geoff, do you foresee any chance of the interest rates going up in the short term?
Yeah. Actually, put on the next slide. Put on the next slide.
Sure.
Because interest rate expectations. Okay, it doesn't come up that well. All right, interest rate expectations. They are a key driver, right? Do they go up or not? The answer is, it really depends on the amount of slack still in the global economy, the output gap per se. If you look at the US, you've got, I guess the year-on-year growth in money supply has subsided, number one. Number two, tapering is expected to start before the end of the year. So that is kind of a, basically a less expansionary, a little bit of a tightening kind of phase. But will interest rates go up? It all depends on the employment market in the US, because COVID-19 has had a really devastating impact on the US employment market. There's still, Neil Kaspari would say, there's still 4 million to 7 million people in the US that should be working today, but because of COVID-19, they're not. So the real thing is employment being the key, I guess the key performance indicator for the economy in the US. That has to basically begin to show more signs of normalization, more growth before you see interest rates in the US. That's for sure. Right. Interest rate changes in the US, and that impacts us as well. It impacts the whole global interest rate market.
Okay. All right. So this brings to the question from Sija. I'm not sure whether you are able to answer this, but he's asking, if interest rates do
Yeah.
increase, which bank is more favorable?
Okay. Well, let's see this chart. The orange line, see chart. The orange line is the global banks prices. The blue line is the 2 to 10 US yield curve. So the short term treasuries are the 2 years, the long terms are the 10 years. Banks make their money by borrowing their money at the short term rates and lending out money at the long term rates. So the steeper the curve, the higher the yield curve, the higher the difference between the 10s and the 2s, the more favorable it is to the general banking model.
Thanks, yeah.
Okay. So I guess you probably understand that. So, but let's have a look, because I've got as you can see, from the end of last year through to the end of the first quarter this year, your yield curve steepened by 80 basis points. And you can see OCBC actually outperformed during those 3 months, up 17%, versus DBS, which was up 15%, UOB was up 14%. Then on the 31st of March to the 19th of July, your yield curve actually flattened by 60 basis points. Global banks were flat. DBS was more defensive. It was up 4%, UOB up 1%, OCBC up 2%. The yield curve, the interest rate, the yield curve then increased. It increased by 10 basis points from the 19th of July to 22nd of September. And you saw UOB actually the stronger of the three, but albeit there was not much difference. OCBC was down 2%. Then if you look at the steepening more recently, the 15 basis point steepening in the 2 to 10 curve, you can see DBS basically and UOB kept pace with the global banks, while OCBC wasn't. So, that you can see. I mean, that's what's happened with interest rate increases over or changes, if you will, in 4 distinct phases over the last since over the year to date.
Right. That's a
Yeah.
wonderful chart that you put up there.
Yeah,
You
can just see how it's playing out, and this is all based on the current financials and the different ratios and so forth. What you can see what's been a little bit more defensive and what hasn't.
Right. Okay, thanks. So we have looked at several factors earlier, but what do you think? Are there any other factors that could drive the banks in Singapore?
Yeah, I mean, that yield curve is really important because the trio of the SGX listed banks, they I guess they were less correlated to their global peers over the past quarter. We had that, I guess, that move in the yield curve, and what was interesting was that DBS, UOB, they finished the quarter averaging a 2.6% gain. That was smack back in line with the Bloomberg World Banks Index, which was up 2.8%. But OCBC, as we said, declined 1.8%. That I should just mention too, that yield curve also has a pretty big impact on the REIT sector, and we can talk about that another time. But we'll talk about that another time. But basically, we saw the yield curve move in such a way that when the US 10-year yields basically drive the steepening of the yield curve, the higher yields on the long end, they decrease the yield premium that REITs hold over interest rates. So like global REITs, we saw our IHS REIT index basically gain 4% from the 30th of June to the 4th of August while that yield curve was flattening. Then when the yield curve actually steepened, the global REITs and our IHS REIT index basically declined 4%. So it's interesting that the yield curve steepens. It's good for the banks, but not so good for the REITs because that risk-free interest rate per se to the yield premium that the REITs have, it shrinks and compresses. But look, I mean, for the quarter ahead, the key drivers will be interest rate expectations, obviously, in addition to how well the banks and the bank's customers, I guess, and adjacent industries can obviously contend with the ongoing COVID-19 constrained growth. Global trade, demand for commodities is all important. I guess, as we said, China economy too is important for the region, and it has seen pretty significant deceleration in its growth over the past 3 months. I guess this half of the year did start with the IMF. It trimmed its growth forecast for China from 8.4% to 8.1% for 2021, and we've had all the high frequency economic indicators have been weaker and weaker, I guess. So much so that I think from the 30th of June, your FTSE China A50 index has declined 10%. The H share index is down 17%. FTSE SD China index down 4%. PMIs have moved into contraction, and what that meant from the services side and the manufacturing side as well is that China retail sales year-on-year growth, it has decelerated from as much as 23% year-on-year in the first 6 months of this year down to 18% for the first 8 months. Industrial production's also decelerated from 16% growth year to date in the end of June to down to 13% year to date for the end of August. And the thing is, what's kind of driving this is also China's COVID-19 containment measures. The number of cases, they are comparatively low in China, but they do have a very bold zero COVID policy approach that restricts mobility and contains economic activity, and that obviously weighs the economy. Yet, at the same time, China has remarkably administered 1.1 billion doses of COVID-19. No, sorry, what is it? It's at least one dose to 1.1 billion people. So what a lot of focus will be, Benny, for the weeks ahead, I should say, as we get through Golden Week, won't just be also the real estate market, but also on any signs of China easing its strict COVID-19 containment measures as well.
Right.
Okay. But,
okay, it's interesting.
Yeah, but I mean, a key driver is obviously that yield curve as we discussed.
Okay. All right, thanks. Okay, there's a question from Terence Lims. Before we move on to the next part, he's asking basically, as the bank share performance has any bearing on the weakness of SGX share price? I'm not sure whether it's the SGX or the Singapore market.
Terence, he's asking the question because the SGX share price has come off, and had some institutional outflows for the last since last couple of months or so. No, that's competition. That's Hong Kong Exchange listing futures contracts that can compete with our existing futures contract suite. So that's the market reacting to we have an incredible derivatives market that is Pan-Asia focused, has outstanding contracts for the China market, the Taiwan market, the Japan market, the India market, and basically there are other exchanges that also want to introduce similar contracts and compete, and that's all it comes down to. At the end of the day, that's the biggest driver of the share price. The fact that we're not just a stock market, we're also a derivatives market, and it's a very competitive marketplace for derivatives. But SGX really values its customers and its clients, and we had a migration from our old Taiwan contract to a new Taiwan contract provided by FTSE, and that was on the back of competitive initiative that was made from another exchange, and we managed to keep much of that business because, as we said, at the end of the day, financial services, it's a business that's you really need to trust your counterparties, and you have to, as we said, it's services, and you really have to value your customers. So we make sure every single customer that we get at SGX, we value them, and because it is a super competitive industry.
Right. Okay. Thanks, Geoff. I hope that answers your question, Terence. And yeah, before we end, it's almost coming to an end, Geoff. Thanks for your insights on the banking sector. And if you guys have any questions, please do type it down. We still have a few minutes left. But Singapore being a the exchange where you have exchange traded products, right, which are investing internationally as well, because in the Malaysian market, most of the ETFs or even REITs are very local based, right, and their assets are all local, they're locally invested. And again, we're going to go back to Evergrande. So are there any notable exchange traded products with exposure to Evergrande in Singapore?
Yep. There's one in particular, the iShares US dollar Asia high yield bond ETF, which has it's declined around 10% in US dollar terms from the end of June to right through to today's close. It was down again today. Its dividend distribution, I guess, trims that decline to around 9%. But this fixed income ETF, it focuses on the performance of more than 300 high yielding corporate bonds, and they're listed across Asia ex Japan, with the majority of the bonds maintaining yields around 1% to 8%. Now, the decline has been on the back of the price of the high yield corporate bonds in China, particularly across the China property sector. And it's because, as of the end of September, this iShares US dollar Asia high yield bond ETF, or I could just call it the HYG, it carried a 42% exposure to China and a 10% exposure to Hong Kong. Now, within the 42% exposure to China, 65% was invested in China property plays, which is around 27% of the overall fund. It had a direct exposure of 4.1% to China Evergrande Group, which is around 1.7% of the overall fund. And that was as of 30th September. And the recent concerns on Evergrande's ability to service its debt obligations, it has seen the price of the China Evergrande corporate bond decline by 70%. A decline over 70% in the year as of 30th Sep. So the average price of the corporate bonds issued by the China property plays has also been impacted. Okay.
Right.
And seeing the average yield of the China segment of the high yield ETF gain over 3% from 10.2% on 30th of June to 13.3% at the end of September. So I guess the volatility in the China corporate bonds, which has been on the back of the Evergrande concerns, it has created this dislocation in comparative yields, with those China bond yields being much higher. And that's been the primary attraction. That's been actually a primary attraction of the ETF in recent weeks. So the inflows that this ETF received in September totaled 855 million Singapore dollars. It's taken the ETF AUM to very close to 1.2 billion Sing dollars now, and that's grown significantly from an AUM of 150 million at the end of last year. It's still it's still got some ways to go till it's on par with its contemporary, its peer, its US listed iShares iBox high yield corporate bond ETF, which is covering global bonds, global corporate high yield bonds. That maintains an AUM of 25 billion. So, if we ever want to get there, there's a long way to go. But look, but I should also mention that because we've got this ETF, and there's the Asia ex Japan one, then they have this global one. So it's always interesting to see how those two move. And since the 30th of June, the Asia high yield bond ETF, as we said, it's declined 10%, while the iBox high yield corporate bond ETF listed in the US, which has a global focus, has only declined 1%. Now the performance differential is around 8%. The 90-day volatility of the iShares Asia High Yield Bond ETF is it's only 8% on an annualized basis. So it's as we said, it has exposure, but it's a very highly diversified ETF with exposures, over a number of countries across Asia, ex Japan.
Right.
Yeah. But the price ratio of the two for the Asia part to the global part has made a fresh all-time low. It's trading at more than 2 standard deviations from its 6-month mean, and the relative pricing basically has meant that has been a big, driver in this ETF, attracting 855 million Sing or $600 million US dollars of funds. It's in September.
Wow,
So
interesting.
I'm not. Yeah, so you can find that that ETF on our ETF page. But as we said, it's seen phenomenal growth in its AUM and inflows as investors have looked to basically take an opportunity. I think the dividend yield on the ETF is around 6%.
Right. All right, thanks, Geoff. Now, before I ask Geoff the last question, guys, you know what? If you are on the SGX campus, thank you so much, because that's where we're going to share the videos and also other contents on Singapore market. If you have not joined the SGX campus, just go on to the SGX campus on Facebook. It's a Facebook group, so you just have to join the Facebook group, because next week we're going to have the first prize giveaway. All right, there are 300 ringgit, and you can win 100 ringgit each. Of touch and go top-ups. All right, all you need to do is to answer simple questions. So it's going to be next week, but we're not going to tell you when and what date we're going to post those questions. So please go into SGX campus and make sure that you hit the notification button, right? Then when we post the questions, you will get notified, and hopefully you are able to answer as fast as possible. And the winners are based on the correct answers, the first 3 winners. All right, so please do go to SGX campus. Our colleague has just provided the link. So you have not signed up for SGX campus, please do sign up now, because next week we're going to give the prize giveaways. Okay, thank you. Now, thank you so much, Geoff, for the for the insights on the banking sector, and also give us also a notable mention on the ETF that has exposure in Evergrande.
It does.
We do want to bring you. We do want to bring you back in our show again. So probably I'm going to ask this last question. Maybe you can talk about the other sectors in Singapore when we meet again. Do you see any standout, sector performance in Singapore in the third quarter of 21?
The standout was the energy sector. It wasn't just Singapore; it was across the world. So the strongest sector across the world was the energy sector in the third quarter, and it was also in Singapore. Albeit we don't have many energy stocks though. So of our 100 most traded stocks, we have 2 stocks. One listed on Catalyst, which is Rex International, and then we have main board listed RH Petrogas. Both are explorers and producers of oil, and they saw combined the highest net institutional inflows proportionate to sector market cap as well over those 3 months. So September was a particularly strong month, with the price of Brent crude oil rallying 8%. It saw RH Petrogas top our 100 most traded stocks by turnover with a 19% return. It topped in terms of the performance ladder, I should say. And Rex International also ranked just outside the top 10 with a 9% gain. Now, OPEC met last night. It's continuing to gradually rise its supply. OPEC do estimate that world oil demand will grow by 4 million barrels a day next year, to very close to 101 million barrels a day in 2022, and that will, in essence, exceed pre-pandemic levels. So energy sector was the standout on a macro basis, but on a micro basis, we also have a lot of companies here that are continuing to engage with corporate restructuring and reviewing to increase their operational efficiency. So it's giving us just as many micro things to look at as there are macro.
All right, there you go, guys. So, energy sector, take a look at it. And of course, I'm not going to put on Geoff's words, but the OPEC are seeing actually quite increasing demand for oil, right? And now that we are opening up the borders, and so hopefully next year will be a good year for everyone, basically, right? Because we have been, maybe not us, but there have been a lot of companies that has been suffering because of COVID-19, and we do hope for a better year next year. So yes, Geoff. Any questions? If there are, if you still have any questions for Geoff, you can ask those questions right now. If not, we're gonna just end the session, right? So I'm just gonna give you guys a minute to ask those questions, and if you don't have questions, I'm gonna let Geoff go. All right, so do make sure that you join SGX Campus, because the video recording for today's session is going to be on SGX Campus. And if you think that this video is going to be interesting for your friends who are interested in the Singapore market, please do share with them. Okay, with that, thank you so much once again, Geoff. It's been really great talking to you. And,
you too, Benny. Thank you.
Looking forward to see you again in our next session.
Yeah, likewise.
Thank you so much.
Can't wait. Thank you,
All
my
right,
friend.
and
have a great night.
okay,
Thank
good
you.
night, everybody. Good
Bye.
night. And good night, everyone. See you again. Take care.